Okay, continue what we were trying last time until the Bloomberg had an error message, is we're trying to bring in some historical data. So I'm going to do import data, real-time historical end of day. The company I'm looking for is Walmart, so I type that in. Then I'm doing next. What I'm looking for is earnings per share. So I type that in. You could probably just type EPS. And what I want is a trailing 12-month EPS. That means each number will be an annual number. That's what I want. I'll then click that there. Next. This is quarterly data, so I'll say quarterly. I'm just going to click on the year. I'm just going to click 1950. It won't go back that far, but I just want all the data available. Click next. Click finished. And it will bring in, these are annual earnings per share for Walmart. I'm going to change the formatting to commas. All the way back to 1989. Now right now there's a formula here that will not work on a machine other than the Bloomberg machine, so I'm going to click everything, hit Control C, come over to the open a new page and right click and paste special. I'm going to paste it as values and number format, so I'll now have it in numbers. And then what I'm going to do is I'm going to do a 3-year growth, 5-year growth, and 10-year growth. These are all rolling numbers. So 3 years, you got quarterly data for 3 years. You don't start with your first one because that's your base. So for 3 years, if you do 1 and just add 1, 3 years times 4, that's 12. So we want to go down 12 rows. And we want to use the CAGR, the compound annual growth rate, which is equal. You take your ending number divided by your beginning number, raise that to the 1 divided by 3, because we're doing 3 years, minus 1, and that will give you the annual growth rate for Walmart, which you can see was very, very high on a 3-year basis. We'll do the same thing for 5 years. We'll do 1 and then plus that plus 1. So 4 times 5 is 20, so we'll go down 20 rows. And we'll do the same thing, equal the ending value divided by the beginning value. But this time raise it to 1 divided by 5 minus 1. You can see again a very, very strong growth rate. So we can copy the 3-year all the way down. We can copy the 5-year all the way down. And then we'll do the 10-year. So 10 years times 4, that's going to be 40. So we go down 40 rows. There's 40. So we'll do equal the ending value divided by the beginning value. This time raise to the 1 divided by 10 minus 1. Get rid of all that previous stuff. Copy that down. And we've now got a graph that we can graph. We can do, I'm going to, let's see, go all the way down. You can see at the end, the last 3 years is only growing at 3%, 6, and 8. So it's been much slower growth here recently. I'm going to insert a graph. I'm going to move it. Well, let me first get my dates in there. So go find that first date. Bring that in. And I'm going to actually edit my dates. And go down to number. And I'm going to do specialize. I'm going to do year. Add. My chart title is Walmart EPS growth. Oops, my cap lock's on, excuse me. Walmart EPS growth. And I'm going to go in and select the data and edit each one. This first one is a rolling 3-year growth. The next one is a rolling 5-year growth. And the last one is the rolling 10-year. Say OK. So I've now got a pretty good looking graph. I don't know why he has the range he does, so I'm going to format it so it only goes up to 0.25 instead of going all the way up to 30%. I'm now going to copy that, bring it over to my paper, and paste special, hit map. So I've now got a lot of evidence for a short-term growth rate. The PEG ratio says a pretty low rate of 4.5%. Their actual return on equity and retention suggests a much higher rate. The historical growth rate suggests that they're certainly coming down and getting weaker. That seems to be more supportive of the 4.5%. I'm going to split the difference, and I'm going to suggest a short-term growth rate of 8%, just knowing that they are expanding in Central America. They have had some challenges here recently, but I think if you look historically, there is some cyclicality to their growth rate, so I think they'll probably come back up. So I'm going to go with an 8% growth rate. And then the last item to get here is the H. Well, remember I said, firms don't grow faster in the economy for long periods of time, especially not double digits. Like Walmart, we're just using 8%, so that's not a really high level. I do think they're going to be expanding in Central America and South America. I doubt they're going to get much more strength in Europe, and definitely not in Asia. The competition there in certain countries, I think, is very strong. It's going to be difficult. They've already had some bad experience in Europe. So I think Latin America is really their growth story. They're getting pretty saturated in the U.S. So I'm going to say 6 years to get from short-term to long-term growth, which means the H is half of that, so your H is 3. So now we have all of our assumptions. All we have to do now is plug them into the model. I'll do that in the last video.